Just to quickly point out, the problem here, this bad loan problem, goes beyond US banks. There were many other financial firms impacted by the same bad mortgage problem. And everybody's seen that one. Even insurance companies who were in the business of insuring those bonds, those securities that were backed by those mortgages that went bad. Foreign banks, UBS is a big Swiss bank that was heavily involved in purchasing US originated mortgages and in particular mortgage-backed securities. And then our friends Freddie and Fannie, who were very heavily involved in the purchasing of mortgages, but then also the issuance of mortgage-backed securities, and recently had to be basically taken over by the government because they were on the verge of bankruptcy. So what have policy folks been doing in response to this situation? Well, I can really talk with some authority about what the Fed has been doing, but let me mention kind of several of the key policy responses and the actors involved. So I'm going to talk some more in a few minutes about the Fed and the Fed's role in providing liquidity via lending. When we borrowed, that funding pressure increased that was on our previous slide. That's when the Fed stepped in to try to relieve some of that pressure by lending to the banks that other people wouldn't. We also lowered borrowing costs by cutting interest rates. By the one interest rate that we actually get to control in the market, the federal funds rate, which kind of sets a floor for other interest rates. So if we lower that, then potentially you might lower the whole term structure and lower borrowing costs in general. This is a big deal. Extending the deposit and lending guarantees by the FDIC. So one of the big things that came out of the Great Depression and the bank runs and It's a Wonderful Life and basic savings and all that stuff, the runs on banks, when depositors became afraid that capital was all being used up, they went running to the door and said, give me my cash now because it may not be there tomorrow. Well, the FDIC was created in 1935, I believe, kind of in response to that, to provide a government guarantee on bank deposits. And the amount that's was guaranteed, I think was set, actually I can't remember where it was set, to 100,000, maybe in the 70s or 80s. It hadn't been changed in a long time. One of the things the FDIC did was raise that ceiling on regular deposit accounts to $250,000. I don't know about you, I don't have $250,000 bank account. So that should cover pretty much most people. Did leave exposed people who were in business, who just had transactions accounts with banks, checking accounts with banks. The FDIC gave unlimited coverage to transactions accounts. And they put guarantees on the bank's borrowing. So they guaranteed the funds that a bank would borrow. This one actually goes into force in a couple of weeks, I think, the lending guarantees. So that one's not actually operational yet. It will be very soon. So the goal here is to promote confidence that, okay, even if bad stuff happens, the money's safe. A bank shouldn't fail because there's a run on a bank. It might fail just because it has so many bad assets relative to its liabilities that it eventually becomes insolvent. But the U.S. has very efficient ways for folding up a bank and making sure that depositors, by and large, are left whole, unless you're carrying around millions of dollars sitting in a bank account in one bank that's FDI insured, in which case that would be really silly. You should have it spread out across several banks. The Treasury, you've probably heard a lot about this. At some point, what the Fed can do is limited. It's limited. We're kind of limited to providing short-term loans to financial institutions. That's pretty much all we have the authority to do. It became pretty clear that that the problem was not going to be solved by just providing liquidity. That banks were really struggling to remain solvent, and some really big banks were really struggling to remain solvent. So Treasury stepped in and they went to Congress. They got $700 billion package. I think Treasury probably wanted just to say, give us $700 billion and we'll figure out what to do with it. Congress wanted to go, well, you want to do this, you're going to do that, you're going to do the other stuff, which is, that's why we have Congress. That's why we have this public sector, the public involvement through Congress, the voice, saying, no, well, this is what we, the representatives, want to happen. One of the things that the Treasury has done is to add capital directly into, back in that chart with the balance sheet, the capital piece of to directly shore up the capital base by buying equity in banks through buying preferred stock in banks. It doesn't give the Treasury voting rights, but it does provide the banks with more capital to kind of shore up the capital base. There was initially there was talk of the Treasury going in and trying to buy those bad assets through take them off the books and have them sit there for a while and then kind of put them back out in the market in the future. It turned out that proposal, which I still think actually has a lot of merit, was not going to be a timely thing. To figure out what those assets are, let alone design an option mechanism that would give a reasonable signal on what the value of those things are, is going to take too much time. And so that's kind of seems to have been put on the back burner right now. And then ultimately, got to prevent more loans going bad. And that's efforts like foreclosure prevention, actually working with financial institutions and homeowners to figure out ways for them to stay in their homes and not go into foreclosure, because when foreclosure just puts homes back on the market. In Florida currently, over half the homes that are sold each month in the whole state of Florida are foreclosed properties, or sales of foreclosed properties. That just keeps driving home prices lower, which just keeps driving foreclosure rates higher. And then, and everybody's kind of been involved in that. The FDIC, the Fed, and Treasury are all involved in various ways in foreclosure prevention initiatives. And then stimulating the economic activity, you can prevent loans going bad if the economy is growing. And as you'll see in a moment, the economy right now is not growing. So it needs some stimulation. Let me talk a little bit more about the Fed's liquidity action. So last fall, when it became clear that more default rates were heading north at a much faster clip than banks had planned on, then the pressure on banks' balance sheets started to increase. They had these bad loans, and then people were like, oh, am I really going to lend to that bank anymore? I'm not sure that bank's solvent. I don't know what those assets are worth. So the funding costs for banks rose dramatically. I'll show you a chart to illustrate that in a second. Because of this increased riskiness of the banks, and also there's just increased demand for liquidity. They needed cash. Banks needed cash in a very significant way. So the Fed responded by making short-term loans to banks. That's kind of one of the reasons the Fed was established in the first place, was as a lender of last resort. It's not a thing that the Fed has had to do very often at all, but it is one of the reasons we exist, is to make short-term loans to banks when the access to liquidity in the market has dried up for whatever reason. So